Yeah.
Dude, how many?
And she did it, and she lost it
This year?
Really?
Yeah, 2 in New York and 1 in Palo Alto.
Very
I
cool.
wanted to know that
Yeah, the Dan Legacy Road.
crazy. Her mom was
See how long everyone's
Do this summer and be like, you know what? Fuck this.
I'm
the whole thing. It's like, I know.
hard to travel. Because I'm doing.
That's, oh, and
I
then
feel like
like,
everyone's
look,
probably like the mass group of people go and everyone's like, wow, it's an NYU pub. And they'll just
Like this year. I feel like with bonus season, we have bonus season, we have like a golden 3 or 4 year rush.
I like it. Like, oh yeah, time to
Huge
go.
bonus season, then they're gonna get shafted. And mass.
On Wall Street. Table thing that you're on.
Oh yeah, I didn't check my email for it.
yeah.
I got it. It was
Oh, yeah. For Father's Day. Oh my god. I felt fucking mad at me. Like,
What's the newsletter called? Or it's like, oh, sports.
Oh my god. But like people that like obviously weren't participating. Yeah, no. Like I feel
Literally 3 people out of the entire 3 days. Like, intentionally worth
like
yeah.
the week of the
But how would they motivate?
There's only one person left on the orphan group who's not in the group yet. Not on the orphan group, I haven't seen your name, so.
Professor, I don't think your mic's on.
Incidentally, I got a new mic that goes over. I asked them to get me one of the over the head mics because I think it's easier to pick up the voice from within the mask. So let me ask the question again so you can see each other. Who's not in the group yet? Okay, so the starting point might be to put your names down because on the orphan list, there's only one person on the list right now. So if you put your names down, I mean, you might get a critical mass going. So second, how many of you picked a company? If you picked a company, put up your hand. Okay. Okay, so we're not quite there. By the end of this week, I hope you pick a company, right? So as I said, don't put it off. Don't hold off until the perfect company shows up. I mean, you're getting a multitude of riches landing on your lap, given how the market's behaving this year. I mean, you could pick Facebook, you could pick Peloton, you could pick Amazon, depending on good news or bad news, whatever you want, it's happening in the market right now. So pick a company. And again, as I said, I will ask again on Wednesday, hopefully more names will go up. Any questions before I start the class though? So start of every class, we're going to have the start of the class test. I promised you that as well. So today's test, we're going to start with consistency. I mean, we know when we talk about discounted cash flow valuation, we say there's a cash flow, there's a discount rate. And all too often, I think people are sloppy. They say, I have a cash flow, I have a discount rate. What's the big deal? And today we're going to talk about the big deal of not matching up your cash flows to your discount rates. So I'm going to give you a preview of something we're going to talk about much more seriously today. When you look at valuing a company, there are 2 ways you can approach valuation. The first, you can focus your attention entirely on the equity investors in the company. Look at the cash flows they get from the company and discount back at a rate of return that they need to make on that investment. Remember, there are only 2 ways you can raise capital as a company. There's equity, there's debt. So in the first approach valuation, you focus on equity, you look at the cash flows equity investors get, and you discount it back at a cost of equity. Now, if you think about a publicly traded company and being an equity investor in a publicly traded company, what's your only cash flow you actually get from the company? It's tangible that you can point to. That's a cash flow. What's the only cash flow you actually get from the company? Dividends, right? Everything else is illusion, or at least an estimate. The only cash flow, so a special case of an equity valuation model is the dividend discount model. It's the oldest discounted cash flow model around. It's been around since the 1930s. It's a model that actually, if you look at Ben Graham's security analysis, the traditional books are built around the dividend discount model. I think it works in about 1 out of 100 companies. We'll talk about why the dividend discount model has fallen out of favor and why it's not the model of use. So the dividend discount model is an equity valuation model. So that's the first way you can approach valuation, is to focus on just the equity claim, discount back at the cost of equity, come up with the value of the equity. There's a second way you can approach valuation. Rather than focus on just the equity investors, bring the other capital providers into the game. Who's the other capital provider? The lenders, right? Equity investors get residual cash flows, whether it's dividends or whatever cash flows left over after everybody else has been paid. That's what equity investors get. What do lenders get as cash flows from the firm?
Interest.
Interest payments, and in some cases, principal payments, and we take on. So basically, lenders get cash flows as well from the firm. This is going to sound unnatural because when you own a firm, you think of lenders as outsiders, but think of lenders as part of the game. You two people providing capital to the firm, equity investors and lenders. Equity investors get cash flows, lenders get cash flows. What if I added the two cash flows together and looked at the collective cash flow that both claim holders get? That's called the cash flow to the firm. So now I'm looking at the collective cash flow you both make. So when I'm looking at that collective cash flow, the discount rate I should be using should no longer be just the cost of equity. It should be a weighted average of what equity investors want, which is the cost of equity, and what lenders want, which is the cost of debt, which in corporate finance, of course, is the cost of capital. Cash flows to the collective firm discounted back at the cost of capital gives you the value of the entire business. Now, still, let's assume you're still interested in just the equity investors. What do you need to do to get to the value of equity if you've got the value of the firm? What's the last step? You need to subtract out the debt you owe. So you value the firm at $2.5 billion, you subtract out the debt, you come up with the value of equity. So there are two ways you can value equity. One is by focusing just on equity investors, looking at their cash flows, discounting at the cost of equity. The other is to value the entire business and subtracting out debt. Saying which one should I use? We'll talk a little bit about that today, because I'm going to say something very strange. It doesn't matter which way you go. If you do it right, you should get the same value for equity. But doing it right is, in fact, one of the most difficult things to pull off in valuation, is getting that consistency right. So I'm going to start today by making a statement. This is a first principle in valuation. You cannot mix and match cash flows. But it's amazing how often I see it violated in practice by banks, by consultants. You'd think they'd know better, right? So let me take you back to the late 1970s. Tell you a story because the story has an end game. It's about a company called Kennecott. It's a copper mining company. And Kennecott in the late 70s owned a mining subsidiary, a coal mining subsidiary called Peabody Coal. The antitrust laws kicked in. They were forced to divest themselves of Peabody Coal. So you're saying, so what? They had to sell Peabody Coal. They got $600 million in cash for the sale. They were about a $2.5 billion company. So right after the sale, they got $600 million in cash. And they're a small company. And it scared them. It scared the managers of the company. Let me ask you a question. If you're a $2.5 billion company and you got $600 million in cash, what's scaring you? What are you afraid might happen to you?
Take over.
They were worried that they'd be taken over. With $600 million cash sitting around, it makes an acquirer's job a lot easier because now that's cash. So when you come up with money, you don't have to come up with $2.5 billion. You got to come up with only $1.9 billion. It makes their job a little easier. Let me ask you a follow-up question. What's the most logical way to get rid of $600 million in cash if you don't have a use for it? You're a publicly traded company. You've got $600 million in cash that you don't have a use for.
Buyback.
Give the cash back, right? These were the days before buybacks, pay a special dividend, give the cash back. That thought never even crossed Kennecott's mind. Their reaction was, Hey, what would shareholders do with all this money? Stupid things like pay bills, maybe reduce their mortgage, buy a car. We can't allow that to happen. So what's the stupidest way to get rid of cash quickly? If you don't want to return it to shareholders, you want to get it off the books because cash is the problem. What's the stupidest way to do it?
Bonuses.
All right, what?
Bonuses.
Buy assets, but you want to buy a really big asset, right? What's the chance you get as a company? When you spend a lot of money quickly, what do you usually? They did an acquisition. So let's play out what happens, right? Your Kennecott, you got 600 billion in cash. You want to do an acquisition. So who do you think they approached? They approached an investment banker. Right? That at that time, First Boston was the leading M&A bank on the street. They went to First Boston. They said, "We have 600 million in cash. Can you help us spend it?" This is like walking into Bloomingdale's with $5,000 in cash. They, "Can you help me spend it?" But if people are working on commission, I don't know what they do in Bloomingdale's, you're going to get a lot of help that day. And First Boston said, "Of course we can. That's a specialty." So First Boston went out and found them a perfect target company. What's perfect about the target company they found? Magically, it was worth exactly you could do the acquisition for exactly $600 million. Now, this is one of the first rules in acquisitions. The value of a target company will magically rise to however much cash you have on your balance sheet to get the deal done. And of course, as a bank, they had to do fairness opinions. And that time it wasn't legally required, but they had to say this was a good deal. So they came up with a valuation that would justify the 600 million, which means the value has to be greater than 600 million. So I'm going to show you the worksheet for the cash flows they used. These are the actual cash flows they used. It became part of a Harvard Business School case. It became a strategic case. Nothing at the Harvard Business School ever remains a finance case. So they didn't even have any qualms about sharing it. So I'm going to take you through how they computed cash flows. And I have a very specific question I want you to think about the answer to. I'm going to describe the way they compute cash flows. And the question I'm going to ask you is, what discount rate would you apply on these cash flows given how the cash flows were computed? You ready? Here's how they computed the cash flows. They start with revenues. They subtract out operating expenses. They came up with expected operating income in the future. Then they subtracted out interest expenses. In fact, they started with net income as their basis of earnings, subtracted out debt payments to come up with a cash flow. So I've kind of told you how they computed cash flows. They started with income. Now, after interest expenses, they netted out debt payments, came up with cash flows. So those are the cash flows they came up with for the target company. It's called carborundum. It's an abrasives company. So I'm going to give you 6 different discount rates you could apply on these cash flows. Only one of them is right. And I want you to tell me which discount rate you should be applying on these cash flows to come up with the present value. So you're not even contesting their cash flows. You're taking the cash flows as a given, but given how the cash flows are computed, you got to pick the discount rate. So here are your choices. You can use cost of equity or cost of capital. So let's pause right there. Given how I just estimated cash flows, or I told you how they estimated cash flows, which of those 2 discount rates are you going to use in your discounting? Go ahead. Cost of equity. And tell me why. The key clue was I netted out interest expenses and I subtract it's cash flows after debt payments. The minute you do that, you got cash flows to equity. So you can cross through the cost of capital. None of the cost of capital apply because these are cash flows after debt payments. Now comes the trickier question. I have 3 different costs of equity I can use. I can use the acquiring company's cost of equity with the argument that the acquiring company is coming up with the money to do the acquisition, so it should be their cost. I could use the target company's cost of equity with the argument that these are the cash flows, the target company, and that's the discount rate that best reflects its risk. Or I can use a melded cost of equity, what the cost of equity will be for the combined company after the deal, which will be some weighted average of the acquiring and the target company. So as I said, this is a trickier question. Anybody want to try and tell me which discount rate?
I think we should use the targets possibility.
Use the targets. It's one of the, it is in fact the right answer, but in half of all acquisitions, people pick the wrong number. So obviously there must be some pushback against it, right? So let's say you're at an M&A bankers group now, you're doing the deal and you come with the cost of equity. I'll play devil's advocate, but it's our money, the acquiring company's money. Why are you attaching a disc? It's cost of capital, right? It's cost of raising funds. So give me the logic or the intuition. Why, even though I'm raising the money, I should be using the target company's cost of equity?
I think the reason is because we are assessing the risk of the target company. So therefore, we want to use the rate which can capture the risk in the target company.
Let's go back to first principles in discounting. First principles in discounting say the discount rate you should apply to discount cash flow should reflect the risk of the cash flows, not the risk of the entity or person looking at the cash flows. In other words, you could be the safest company on the face of the earth, but I come to you with a social media company or an artificial intelligence company to value. You shouldn't be using your discount rate because it has nothing to do with these cash flows. It should always be the target company's discount rate that should be used to value the target company. That number would have been 16.5%. Since you're on the spot, I'm going to ask you the follow-up question. If you were going to pick the worst possible choice here, wrong on every single count, which discount rate would you have picked to discount these cash flows?
The worst choice here is the cost of capital of the acquirer.
In other words, if you wanted to get as far from the truth as you could get, you'd pick the wrong company and the wrong discount rate. Guess what? Which first Boston picked? Wrong company, wrong discount rate. They used a 10.5% discount rate, the cost of capital for the combined company, for the acquiring company, as the discount rate for the cash flows. Think about it. You take their cash flows and accept them as given, right? I'm not even contesting their assumptions. Instead of using the right discount rate, which in this case would be 16.5%, they used 10.5%. That's how they got the $750 million to justify the deal. If I took those same cash flows and applied the 16.5% discount rate I should have, the value I'd have got would have been $450 million. So think about what they made Kennecott do. I didn't make them, but they encouraged them to do. They encouraged them to pay $600 million for something that based on their own estimate should be worth only $450 million. And for this they got advisory fees. What kind of advice is this? This is a horrendously bad acquisition. But to show you how this plays out, it wasn't legally challenged. The only way we found out is 10 years later as an exhibit in a case study. And then the question becomes, how could they make such a horrendous mistake? I mean, we're in session 3. This is one of the first things we talk about in discounted cash flow valuation. How could this slip by? One very cynical reason is they knew exactly what they were doing. They're smart people. They did this because they wanted the deal to go through. I can't rule that out, but I think there's a much more believable reason, which is if you've ever worked on an M&A deal or any kind of deal in investment bank, here's what happens. You're given a fake deadline. You know what I mean by a fake deadline? It's got to be done by midnight today. Why? Just because they want to make your life miserable. You got 5 people, 3 people work on the cash flows, 2 people work on the discount rate. It takes them all the way until 11:54, 6 minutes before the deadline, the 5 people gather together. The 2 people into the discount rate come up with the discount rate number, the 3 people into the cash flows come in the cash flow number, and they put them into evaluation. Who has the time to stop and ask? I mean, each group did what they thought was the right thing, right? Estimating a discount rate, but because there was no real sense of what they were doing, this kind of mistake can happen all the time. When we talk about acquisition valuation, I will bring evidence that half of all M&A deals are flawed right from the start. Forget about getting the cash flows and disagreeing with the cash flows. They're flawed because you're mixing and matching cash flows and discount rates. You know who ran First Boston in the 1970s? Two legendary bankers. One was a guy called Bruce Wasserstein. His sister, Wendy Wasserstein, is the playwright. You might have heard about her plays, at least. You know what his name was on Wall Street? Bid him up, Bruce. He was famous for getting deals done. And his co-partner was a guy called Joe Perella. If there were any justice in this world, what should have happened right after they did this deal? They should have been banned from ever doing a deal again, because if you don't understand how to value things, you shouldn't be doing these things. You know how they got rewarded? They created an outfit called Wasserstein Perella. And I talked about them last session. It's the guys who brought down the practice of valuation 6 notches. And they did bad deal after bad deal. It's amazing how they screwed up every single first principle in valuation as Wasserstein Perella. You see, the punishment must, you know how they got punished? Dresdner Bank bought Wasserstein Perella for $2.4 billion. I can't even make up this crap. But the rationale that Dresdner gave was, we're buying them for their valuation expertise. There's no punishment in this business for doing valuations badly. She's saying, why am I taking this class? Hey, if you're going to be moving up the M&A process, don't take this class. This is not about getting valuation right. It's about playing games with cash flows and discount rates to justify a predefined end. But if it's your own money as an acquiring company, you can't blame the banker. If you're Kennecott, don't come to me and say, First Boston made me do it. No, nobody made you do it. You turned this process over to them and you said, you're the experts, but this doesn't need expertise, right? It's first principles and valuation. Somebody should be asking these questions. So remember this particular page. And here's why I want to remember it, because many of you, even if you don't do valuation, we're consumers of other people's valuations, right? And sometimes you'll see the name on the top of the valuation. It's going to be intimidating. Goldman Sachs and KKR, Goldman Sachs, JP Morgan and KKR. And your reaction is going to be, hey, if Goldman Sachs and KKR are both putting this valuation together, they must know what they're doing. And this page should be a reminder that you can have the biggest names on the top of a valuation and incredible screw-ups happening under the surface because people are sloppy. Now, I actually have a presentation called Just Because you have a D and a CF doesn't mean you have a DCF. Because there are so many bad ways to bring together D and CF to create a bad DCF. Any questions about this process? Because we're going to dig a little deeper into equity versus firm, why the two give you the same answer. But that's on the agenda for today. Okay. So let's close. Let me start my sharing here. So I hope you've got okay, so I hope you got the first lecture note packet. If not, try to get it by the end of this week. So today we're going to start on intrinsic valuation. So let me lay out again what I said in the last session. We talked about there are three basic ways to put a number on a company. I said you can do an intrinsic valuation where you value something based on its cash flow, growth, and risk. And I talked about discounted cash flow valuation as a vehicle for doing it. I said you can do pricing, where you look at what other people are paying for similar things. And I said to do that, you got to convert the price into a standardized version, price earnings, EV to EBITDA. So when you use multiples and comparables. And really get to the third way, which is a contingent claim valuation. Let me at least give you a sense of what that is. In contingent claim valuation, if you have an asset whose cash flows are contingent on something happening, A pharmaceutical company, a small pharmaceutical company with a drug working its way through the FDA pipeline. The contingency there is, if there is approval for the drug, it could become a multi-billion-dollar business. And if not, it crashes and burns. An oil company with undeveloped reserves, but those reserves are too expensive right now to extract. The contingency there is if oil prices go up enough, those reserves could be worth a lot. It's called real options. And I'm going to come and talk about that towards the end of this class, but I'll tell you upfront that I approach this entire area with a lot of cynicism because I've seen people use the word real options essentially as a buzzword that you pay a premium for. But if you think about real options as something that could potentially add value, it allows you to pay a premium over the intrinsic valuation of something. So if you value an oil company at $1 billion, to the degree that oil prices are volatile, you might say, I might pay a premium. We'll talk about how much that premium should be. It works in about 3 to 5% of companies. So if you find yourself using real options in every company of value, you wandered off and basically done something that should not be done. But fundamentally, there are 3 ways you can put value. And I said intrinsic value, pricing, and real options. We're going to spend the first half, perhaps in the first 16 sessions of this class, on intrinsic valuation. So let's restate what we're trying to do in intrinsic valuation. We value an asset based on its cash flows, growth, and risk, but it works only for cash flow generating assets. So don't try to do an intrinsic valuation of a Picasso. Don't try to do an intrinsic valuation of Bitcoin. Don't try to do an intrinsic valuation of the US dollar. You can do intrinsic valuation only if you have a cash flow generating asset. Incidentally, since we're talking about it, cash flow generating asset, you heard of NFTs, right? What are NFTs? Basically, you buy a small slice of something virtual. Now, one example is, I don't know whether you've seen this GIF of this girl who's laughing, and behind her there's a burning house. So she's smiling, and there's a burning house. It's one of the most widely used GIFs over the last 20 years. Somebody bought that GIF for $650,000. Or you can buy a clip from an NBA game of maybe Michael Jordan with his star. Remember the hanging shot he makes to win the. So at one level, you're saying that's like a Picasso. I own it because I like to show my friends, look, I own the original clip of that video or the gift. But could you make a cash flow generating argument about NFTs? Let's say you own the rights to that, that gift with the girl with the. That's been used in ads before. Up till now, when you use that GIF in an ad, you didn't have to pay anybody because nobody owned it. Now somebody owns that picture. If you decide to use an ad, you could argue that you can collect cash flows on it. So there is an argument, though you're stretching the definition of cash flow generating asset, that some NFTs can be valued as assets. Something we'll come back and talk about maybe later in the class. But you can value an asset only if there are cash flows. And discounted cash flow valuation, at least in the last 70 years, has become the tool that we use to compute the intrinsic value of a company. Why? Because we have all the mechanics nailed down. So let me show you the 2 ways in which you can do discounted cash flow valuation. The first is going to be familiar because this is the way that you will usually see in textbooks. But I'll give you an alternative, which is seldom used, and we'll talk about why it might be seldom used. So here's the first way you can do discounted cash flow valuation. To value an asset, you take expected cash flows. So all the potential scenarios are captured in an expectation. Good, bad, everything's in there. Come up with expected cash flows. Not conservative cash flows, not aggressive cash flows, but expected cash flows. And then you discount those cash flows at a risk-adjusted discount rate. That's why typically discounted cash flow valuation is done. So all of the work of conveying risk in your valuation is on the shoulders of the discount rate. There's a second way you can do discounted cash flow valuation, which, and while it's seldom used, it's good to know that it exists. In this approach, what you do is instead of taking expected cash flows, you take what are called certainty equivalent cash flows. Sounds abstract, right? But let's take an example. Let's suppose I come to you with a gamble. What's your name? Rakesh. Rakesh with a gamble. And here's the gamble. You have an investment which can either pay 100 million with 60% probability, or nothing with a 40% probability. That's the bet. And you have to pay for it. How much would you be willing to pay for that bet?
The expected value is 60. So I might pay something like this, around 60.
In fact, if you paid exactly 60, you know what you've told me, right? You're risk neutral. In which case, there should be no risk adjustment because you're paying the expected cash flow. The essence of risk aversion is if I give you that bet, you're going to pay less than 60 million. Have you ever seen Let's Make a Deal with Howie Mandel on TV? Don't watch the show. It's a terrible show, but in case you watched it in the past, it's a show where people are often offered exactly what I offered Rakesh. There'll be suitcases up on the top, and there'll be two suitcases, one with $1 million, one with nothing. And the contestant is offered, so Howie Mandel will say, I'll give you $300,000. Will you take it? So you're faced with a choice, right? You can take $300 guaranteed, or you can go for the bet. But there's a very real chance, a 50% chance you could get nothing. And if you're risk averse, what you're going to do is you're going to settle for less than 500,000 because 500,000 is the expected value. And how much less will depend on how risk averse you are. You say, what's this got to do with discounted cash flow valuation? Let's say you sit down to value Coca-Cola. You project out the cash flows. You have 100 million next year, 150 million 2 years. Remember, these are expected cash flows. And then I play a Howie Mandel game. I come to you and say, look, you got $100 million expected cash flow in year one. How much would you expect as a guaranteed cash flow to give up that 100 million? And a certain equivalent, you'll settle for maybe 80 million if you're risk averse, or if you're even more risk averse, 65 million. So you take every expected cash flow and replace it with the certain equivalent. Now, do you see why people don't like to go this route? Because what you need to do to adjust your expected cash flow to a certain equivalent is exactly the same kind of hard work you'd have to do to adjust the discount rate for risk. You're gaining nothing. But if you can pull it off, you end up with these cash flows that are now certainty equivalent cash flows. And because they're certainty equivalent cash flows, the discount rate you apply can be a risk-free rate. So effectively, you're doing the same thing. It's just through the cash flows. Go ahead.
Wouldn't that have a tendency to undervalue the company?
No, because if you do it right, I mean, same reasons, but you're not double counting, right? In the first approach, what are you doing? You're adjusting the discount rate for how risk averse you are and using a higher discount rate. The second approach, you're reducing the expected cash flow for exactly the same reason. And if you're being internally consistent, the adjustment you should make to expected cash flows should be exactly equivalent to the adjustment you'd have made for the discount rate, if you do it right. But to do it right, you got to go through this process of converting expected cash flows to certain equivalents. One of the delusions that I've heard analysts state is, I've adjusted for risk already. So what do you mean? I took all the scenarios, attached probabilities to these scenarios, and came up with an expected value. That's not risk adjusted. That's still an expected cash flow. To risk adjust, you actually have to now replace that with a number you would accept as a guaranteed number. Go ahead.
So would there be any deviation between two? And
No, if you do it right, you should get exactly the same answer. The problem is, I've never seen anybody even try to do the second approach. Because think of how messy this is going to get, right? It's not just 1 year cash flow. It's year 2, year 3, year 4, year 5. But I'll tell you kind of a simplified version in practice. And I'm going to draw on a name that I've used before, Warren Buffett. Right? People take everything he says as gospel. And one of the things he said, and I don't know when he said it, maybe 25 years ago, is during a meeting, he said, I do not risk adjust cash flows. I use the risk-free rate as my discount rate. And I think that's crazy. But of course, people read that and said, I remember people coming to my class that year it was in the news. They said, why are you adjusting for risk? Warren Buffett doesn't adjust the discount rate for risk. Of course, Warren Buffett's reason was he doesn't like the CAPM. Basically used the risk and return argument, but that's separate from adjusting the discount rate for risk. So how does Warren Buffett get away with it? And the answer is actually very simple. If you look at how Warren Buffett values companies, very opaque. There's actually nothing I've ever seen where he actually takes you through the process of how he values companies. He talks about the things he looks at, but he does mention that when he looks at a company, he looks at only the earnings that he can count on. You know what he's basically saying? Like, you give me a company to value, I'm going to take the earnings, but rather than count all of the earnings, I'm going to take only that portion of earnings that I think is sustainable, that I can count on. Basically, what he's doing is coming up with his own version of certainty equivalent cash flows. Of course, he's being very fuzzy about exactly how he adjusts, but you can see that if I gave you a mature company, you might be able to play this game and say, it's 80 million, I act like it's 75 million because that's your. Now, do you see one reason why Warren Buffett has had trouble investing in young growth companies? And we think of them as tech companies, but if you look at his history, he has very few successes. In fact, I can't think of a single one where he's invested in a young growth company where everything lies in the future, because this approach kind of breaks down because it's too fuzzy. But there is a lesson here. I see analysts often using conservative estimates of cash flows to value companies. So what they're doing is they take the expected cash flows, say, I'm going to be conservative. So what they've done is some half-assed certainty equivalent. And then they use a risk-adjusted discount rate on these cash flows. And they wonder why company after company they value, they're getting too low a number. So my advice to you is when you do discounted cash flow valuation, don't play games. Don't do conservative. Just do your expected value. If you want to come and ask what if questions later, it's always accessible. You can do it. But start with expected cash flows, adjust the discount rate for risk, and come up with an expected value. Don't double count. Don't lower your cash flows risk and raise your discount rate. But that's a recipe for double counting. Any questions on? So let's do some intrinsic valuation 101. Now, often when I value companies, I get pushback. And companies like Tesla, I get a lot of pushback on valuation. So we're going to do some intrinsic valuation 101. And I want to pick somebody who's actually never valued a company to be my guinea pig. Anybody want to be my guinea pig? Come on. I'm going to make you look good. By the end of this, people are going to say, you're a genius in intrinsic valuation. Everybody's looking away saying, don't look at me. You want to be my guinea pig? Trust me, I'll make you look good. Okay. See, here's what I have. I have an envelope with nothing on it. So I'm not a magician. So in fact, I pulled up my sleeve so I can't keep doing it. I have a $20 bill. So far, so good. I'm going to put it into the envelope. And I'm going to ask you my first question. How much would you pay for this envelope? Don't think too long, you'll get you into trouble. Go with your instinct. You saw me put. So the answer is $20, which is the answer I usually get. So let's follow up. If you pay $20 for an envelope with $20 in it, what do you get out of this transaction? You get the envelope, right? Which I stole from upstairs somewhere, so it's not worth very much. First rule in valuation, if you know the value of something and you're going to start your bidding, first you get the direction right. You want to start a lower number or a higher number? Lower number. So none of you are destined for banking because bankers usually start with a higher number, then wonder what's going wrong. So you start with a lower number, but let's face it, you're right. This is too simple an asset. And if you had an auction, at the end of the auction, we'd end up with $20. So let's say we've reached that steady state. We're at $20. Now I'm going to try to add some things and see if it makes a difference in how much you're willing to pay. So can you read to the class what this says?
Control.
I'm going to add control to this envelope. So what do I have here? I have $20 plus control. How much did you pay for this envelope? Now it was at 20 before. I've added control. How much did you pay?
25.
Okay. I'll take it. It's an actual transaction. Do you have $25?
You think Venmo?
I'll take Venmo. In which case, what have you just done? You paid $5 for a 3x5 card with the word control, which cost me nothing as well because I stole it as well. You know why I picked the word control, right? What's the reason I picked the word control?
Well, I was thinking shareholder control.
Oh, it's controlled by whoever, right? This is in banking the basis for a 20% premium. It's called a control premium. It's amazing how it's embedded in practice. In M&A, the rule book basically says if you're a banker, you value a company and you add a 20% control premium. For what? Control. Control of what? Control. It's amazing. You can walk around in circles. We'll come back and talk about what the true value of control is. But this case, it's a 3x5 card. Since we're on 3x5 cards, let's keep going. What does this say?
Brand name.
Brand name. If you're marketing, you're doing somersaults, I'll put that in there as well. Now, in addition to $20 in control, you get a brand name. I've spent 100 years building this brand name. Think of how many times people pay premiums for brand names. Since you're still there.
Synergy.
Synergy, I'll put that in as well. And if you really want to go off to the races, what does it say? What I call the theocratic trifecta. You know what's on the trifecta? Sustainability, stakeholders, and ESG. Hot right now, you put that in there, that should be worth at least 30%. I call these weapons of mass distraction. I call them weapons of mass distraction because these words will show up after you value the company. And here's the context they'll show up in. You value a company, you come up with a value less than the price you have to pay to buy the company today. So the number says, don't do the deal. And then somebody, what about brand name? What about control? What about ESG? This will make us look better. In fact, I've reserved the two most magical words for the end. If you're trying to sell something for way more than it's worth, and nothing is working, try these two words. They will allow you to sell something worth 100 million for maybe $1 billion. The first is the word strategic. So it's a strategic deal. You know what that means, though, right? A strategic deal is one where the numbers don't fly, but I really, really, really want to do this deal. The other was a word that you used to use well, but somehow is flipped. And that's what happens somehow. Sometimes these weapons of mass distraction. Read to the class what this says.
China.
China. For almost 20 years now. It's amazing how this word has added an extra zero to evaluation. Now, before you decide none of these words are worth money, I'm not saying control doesn't have value and brand name doesn't have value or ESG doesn't have value. I'm stating something much simpler. I'm going to call it the IT proposition. If it does not affect the cash flows and it doesn't affect, can we please stop talking about it? By it, what am I talking about? Every word you see out there in business. So let's go back to control. Let's forget what the bankers do, forget about the 20% premium. What is the true value of controlling a business? You want to try, what's the true value of controlling a business? You can change the way the company is run, right? So to value control, let's follow up. What do I need to do? First, I need to value the company with the existing management in place. Then I'm going to value it with you in place with all the changes you plan to make. Cutting costs, increasing growth, maybe changing the financing mix. I'm going to come up with two values, right? And assuming you can do things better than the existing management, that difference in value should be the value of control. You know what this implies, right? If you have a company that's already perfectly managed and perfectly run, what should the control premium be? Zero. What the heck are you going to do with this company? If you have a company that's abysmally run, value control can be huge. Think of entities that are badly run. Value control can be huge. There's a reason Peloton is in play right now. Because fairly or unfairly, there's a perception that the existing management is screwed up on multiple dimensions. I mean, I'm not a New York Knicks fan. You know what the value of control would be at the New York Knicks? This is a team that by all rights should be the most valuable NBA franchise. Well, because it is a media market that's huge, and it's got this tradition going back in time. But for as long as I watched the Knicks, they're the most pathetic, pitiful team. And the person you got to blame is who owns the Knicks. The Dolan. This has basically become a plaything for a Dolan, and he's incapable of running a coffee shop. Forget about the Knicks.
Yeah.
If somebody could take over the Knicks, think about the value of control. Let's move on to brand name. We're going to come back and address this much more specifically. What is the true value of having a big, strong brand name? You want to try? What's the value of having this powerful brand name? Either of you? No? Yes, go ahead.
I would say the cash flow will be certain because
Well, I don't know whether cash flow is certain, but you can charge a higher price for exactly the same product, right? That's the power of a brand name. You want to see brand name at play, walk into a CVS, go down the painkiller aisle, check out the price, the aspirin section of Bayer aspirin versus CVS aspirin. If you don't believe me, check out the ingredients. They're exactly the same thing, but look at the difference in price and think of how many times you reach for the brand name. The Sudafed over the generic Sudafed, the Bayer over the generic Bayer. That is brand name at play. And if it exists, you know where it should show up? If you're able to charge a higher price for exactly the same product, your profit margin should be much greater than other companies in the sector. If you truly have a brand name, it should already be in the margins. I won't even go down the ESG system because this is the question I ask. If you're a believer in ESG or a believer in sustainability, how does the IT proposition tell me how ESG affects my cash flows and my risk? And then we're playing a game where we can say this is how much ESG is worth. Basically, any word you see out there used as a buzzword, if it truly affects value, has to show up in the cash flows or in the risk. If it doesn't, we're just playing games with words. So that's the IT proposition. Let me follow up. The second proposition is, and you might not like the title for this proposition, is don't be a wuss. You sit down to value Peloton. You sit down to value Palantir. You sit down to value Alibaba today. You know what you're very quickly going to realize? There's a lot of uncertainty. Lots of things can go wrong. And being a wuss is giving up. Say, there's too much uncertainty. Let me find something nice and stable to value. Just because there's uncertainty doesn't mean you cannot make an estimate. Let's repeat that to yourself. Just because you're uncertain doesn't mean you can't make an estimate. Of course, your estimate is going to be wrong. That's what the uncertainty does. But remember, this is not unique just to you. It's going to be applicable to everybody else looking at the company. When I valued Paytm, the Indian payment processor last year, I felt incredibly uncertain about every number. And guess what? Every person looking at Paytm, including the people running Paytm, face exactly the same uncertainty. So don't let uncertainty stop you from making estimates. My third proposition is what I call the DER proposition. It's named after my daughter, who's now 26. But when she was, I have only one daughter, 3 sons, so one daughter is good enough for me. I remember when she got to about 15 or 16, we were sitting at the dinner table. I'd bring up something that I thought was of profound importance to the family. My daughter who sat across the table from me would look at me and said, Dad, duh. The amount of contempt that oozed out of the duh was so much I stopped talking for like 2 years. The good news is she's now past that point. She thinks I have at least a little bit of sense left in me. But the DER proposition, here's how it goes. And it relates to a particular set of emails I get every week. It's from somebody valuing a company. And they say, I'm valuing this company. I'm projecting out cash flows. And I'm getting in negative cash flows as far as the eye can see. How much should I pay for a company when all I get are negative cash flows? To which my response is feel like slapping the person around the face. Say, wake up. You're valuing something that has negative cash flows forever. What the heck are you doing thinking about paying for this company? They should be paying you. So let's get that out of the way. When you sit down to do a DCF of your company, if all you see are negative cash flows, not just in year 1, not just in year 2, but forever, value should give to the company. It should be 0. There's no place this company's going. But let's make this proposition more interesting. Let's assume you sit down to value your company. And you get cash flows in year 1, they're negative. Cash flows in year 2, they're still negative. Cash flows in year 3, still negative. Part of you wants to use the DER proposition and walk away, right? Don't give up so quickly because you can have companies with negative cash flows up front in the early years still become valuable companies as long as they get disproportionately large positive cash flows in the future. You know why they have to be disproportionately large? You lose $1 billion in year one. You got to make 5 billion or 6 billion in year 10 just to make up for it. You say, when would I ever value a company like that? Some of you said you already picked a company. You're valuing a young growth company, and some of you are. Guess what you're going to see as cash flows in the early years? Young growth companies will have negative cash flows for two reasons. Often the business model is not cranked up yet. They're not making money. And second, what else do they need to do to get that growth? They need to reinvest huge amounts to get that growth. They're acquiring customers, building factories. You value Nikola. Even if you're an optimist in Nikola, there's no way your cash flows are turning positive, probably for 7 or 8 years. Doesn't mean Nikola is worth nothing. It just means you got to be realistic about estimating those cash flows and recognize your cash flows come after a particular period. Those negative cash flows in the early years are called cash burn. You see VCs often ring this, oh my God, there's a big cash burn in this company. If it's a young growth company, cash burn is what you should expect to see. And you should be suspicious about any valuation of a young growth company that shows positive cash flows right from the beginning. So with that setup, let's launch into what I talked about today. As I said, 2 ways to value business. You can focus on equity, look at the cash flows to equity, discount at the cost of equity. Let's call that equity valuation. The second approach, you take the cash flows pre-debt, because you're now looking at debt payments as part of your cash flows. You discount those cash flows at a weighted average of the cost of equity and the cost of debt. And what you get is the value of the entire business. You subtract out the debt, you get the value of equity. So let's take a look at how these approaches play out. So equity valuation, firm valuation. Let's talk about how you get from firm value to equity value. It's kind of a mechanical question. If any of you have done valuation before, let's get this answer out of the way, and we'll come back and kind of dress it up later in this class to talk about exactly what I'm talking about. So let's say you take cash flows of the firm, pre-debt cash flows, you discount them at the cost of capital, you come up with the value of the business. You open your textbook, it says subtract out debt. And so you go looking for debt, right? So I'm going to give you the choices on what you should be subtracting out, and you tell me which of these choices you should use. So this is the debt you're subtracting out from your firm value to get to the value of equity. The first is you can subtract out the value of long-term debt. Just long-term debt. And you can define 3 years or longer, 5 years or longer, whatever you want to define is that you focus only on the debt that's due in the long term. The second is you'd subtract out all debt, which would be short-term debt as well as long-term debt, because remember you have short-term debt and the current liabilities, long-term debt, but you're still sticking with that. The third is you subtract out whatever debt you included as debt in your cost of capital, because remember, to discount your cash flows, you need a cost of capital. And to get a cost of capital, you already had to make a judgment on what to include in debt. Maybe you included long-term debt, maybe long and short-term debt, maybe you included leases as well when you did that. So that's the third choice. Use whatever debt, use the debt in your cost of capital. And here's the final choice. You can subtract out the value of all liabilities. So you're saying what else is going to be in there? In addition to debt, you're going to have accounts payable, supplier credit, deferred taxes, all that stuff under current liabilities. So let's rule the one answer you shouldn't use. Which of the 4 is off the table? Don't use all liabilities. It's going to get you into incredible trouble. You say, what do I do about accounts payable, supplier credit? It shows up as part of working capital in your cash flows. So the real question is, what debt should I use, which is not accounts payable or supplier credit? I'm sorry?
All debt.
Did you use all debt when you did cost of capital as well? You can't use one type of debt definition for your cost of capital and a different type of debt definition when you subtract out debt. So what I'm trying to say is, make your choice when you do your cost of capital calculation. It's too late to do it at the end. So if you want to include something as debt to subtract out, you should be including it as debt when you do your cost of capital. I'll give you the place where this used to show up most often in my valuations until 2019. I've always argued that lease commitments are debt. I've done it for 30 years. Because when you enter into lease commitments, a contractual, remember in corporate finance, we talked about converting it debt. Until 2019, if you looked at the balance sheet, it didn't show up as debt. So when I did my cost of capital, I would include lease commitments as debt. And then when I subtracted our debt, I'd include the lease commitments as debt to subtract. You say, what happened in 2019? What happened in 2019 that's perhaps eliminated the need for me to do this now? IFRS and GAAP have both decided that lease commitments will now be debt. So if you look at a Gap or a Walmart now, part of the debt in the balance sheet will be lease debt. And he says, should I include that? If you're going to do it in your cost of capital, you've got to subtract it out as well. So it's a very simple rule. Keep your debt definitions consistent in both your cost of capital calculation and what you net out. Let me ask you a follow-up question. It's a more philosophical question. There are two ways to estimate the value of equity. One is to take the cash flows to equity and discount the cost of equity and get a value of equity. And the other is to value the firm and subtract our debt to come to value of the equity. Should I get the same answer using both approaches?
Technically, yes.
Would you like to get the same answer? I certainly would. Can you imagine writing an equity research report saying, you know, when I use the equity approach, the stock looked cheap, but when I use the firm approach, it looked expensive. You wouldn't be an equity research analyst for very long if that's the way you hedge, right? So in theory, you should get the same answer. I'll talk about what the implicit assumptions you have to make the two converge. It's one of the most difficult exercises in valuation to get the same value of equity using both approaches. But to illustrate the way they converge, I'm going to take a made-up example where I'm going to make up the numbers and I've essentially set them up to deliver the same answer. So I'm cheating a little bit in why I get the same answer. But this week, I told you you're going to hit a weekly challenge every week. This week's weekly challenge is about delving deeper into why the two numbers could diverge and how to make them converge again. So I'm going to hold off on that. But let's take an approach, let's take a very simple example to illustrate the two approaches. So let's suppose I come to you with a company, and if you've never done valuation, you don't know what a cash flow to equity is, don't worry. For the moment, just think of it as the cash flows left over after everything else. So there are my cash flows to equity. There's my interest expense, net of taxes, and there's my cash flow to the firm. So I've made the estimates for the next 5 years. I've come up with the value of the equity in one case and the value of the entire firm in the second. I also tell you that this company's cost of equity is 13.625%. And the cost of borrowing money pre-tax is 10%, but the tax rate is 50%. So I've given you cost of equity. I've given you an after-tax cost of debt. But to compute a cost of capital, you need weights. So I'm going to give you that final piece of information. Market value of equity is 1.073 billion. The value of debt is 800 million. So I've given you the cash flows to equity into the firm, the cost of equity, and the ingredients you need to compute cost of capital. Let's try valuing the equity in this company first using an equity approach. I take cash flows to equity and discount them at the cost of equity. Remember, the cost of equity is 13.625%. What I get as a present value is 1,073 million. Done. Let's take the second approach. I take cash flow to the firm, but to discount them, I need a cost of capital. So I compute the cost of capital, cost of equity times weight of equity, after tax cost of debt. Remember, the 10% is the pre-tax cost of 50% tax rate. After tax cost of debt, 5%. Weight of debt, I come up with a cost of capital of 9.94%. I discount cash flow to the firm at the cost of capital. What I get as a present value for the entire firm is 1.873 billion. I subtract out the debt, get a value of equity, which is exactly the same in both approaches. I told you I cheated. There's something I've assumed in this valuation that's allowing for convergence. And before I give away the answer, I'd like you to explore with the example that I'm going to send you this week. Check to see what it is that causes divergence, and then what you need to do to make them converge. As I said, it's one of the most difficult challenges in valuation and understanding why the two approaches diverge. Now, of course, if you mix and match, all is lost. So I'm going to restate the principle I talked about. So let's call this the Kennecott Principle or the Wasserstein-Perella Principle. It will make you remember better. Your cash flows have to be defined consistently with your discount rate. If your cash flows are to get equity, they have to be cost of equity. Cash flows to the firm have to be cost of capital. If you discount cash flows to equity at the cost of capital, which is what Kennecott did, you're going to overvalue the equity. If you discount cash flows to the firm at the cost of equity, you'll undervalue the firm. And just to show you how different the numbers can be, because often people say, what's the big deal? Oh, no, one discount rate versus the other. I've taken the example that I just had and screwed it up big time. So first approach, I discount cash flows to equity at the cost of capital. Wrong thing to do, but then the value that I get for the firm is 1.25 billion, which is significantly higher than the 1,073 million. So I've overstated the value of equity because I used the wrong discount rate, which is what First Boston did when it valued Kennecott. It took cash flows to equity and discounted the cost of capital. I've overvalued the firm because I used the wrong discount rate. If I take cash flow of the firm and discount the cost of equity, I come up with too low a value. Why? Because I'm using a higher discount rate than I should. And if I subtract out the debt, the value of equity is understated by 260 million. But the kinds of mistakes people make on this is almost mind-boggling in terms of the range. I've seen people take cash flow of the firm, discount the cost of equity. Cash flow to equity, discount the cost of firm. But when you're mixing and matching, you don't even have an idea what you value in the first place. So I've seen people do a third mistake, which is take that 1.613 billion. They have no idea what they value because they took cash flow to the firm, they mixed and matched cash flows. They say, I don't know what this is, I'll call it equity, in which case you forget to subtract out the 800 million and your mistake got even bigger. Make your choice early in the process. Are you going to value equity and focus entirely on what the equity investors get at their cost of equity, or are you valuing the firm? So for the rest of today, I want to kind of lay out the big picture of how we're going to approach the estimation of all of the different inputs that go into value. We're going to start by talking about discount rates. Yes, cost of equity versus cost. So if you're confused from your corporate finance still about cost of equity and cost of capital, we're going to revisit many of the concepts we did in corporate finance and make sure they get nailed. Second, before we get ambitious, we're going to look at the past. What did the company make as earnings last year? What were its cash flows last year? Not because it's going to matter in your valuation. If you're buying a company today, what it did last year is completely and totally irrelevant. It's done. But you're looking at the past to get some clues about projecting the future. That's the only reason we look at the past. Because in step 3, you take what you learned from the past and you project out the future. Future earnings, future cash flows. And you're going to run into a small problem, and perhaps a big problem. In discounted cash flow valuation, the value of an asset is the present value of the expected cash flows from that asset over its lifetime. So if I give you a 10-year asset, what do? You project cash flows for the next 10 years, you discount them back, you come up with the value today. Saying, so what? You're valuing a publicly traded company, whether it's Peloton or Facebook or Apple. In theory, what's the life of a publicly traded company? You look at a corporate charter, it tells you when the company was founded, right? When does it tell you the company is going to be wound up? It doesn't mention it. In fact, at least in theory, a company can go on and on and on forever. So to value a publicly traded company, what do you have to do? You've got to estimate cash flows forever. This is my vision of hell, an Excel spreadsheet that never ends, right? That's what forever looks like. So in valuation, there's a fourth step, which is at some point in time, you got to stop. You're tired, you're exhausted, you can't keep going. That can't be a reason for stopping, but you got to stop. And you can't ignore what happens after that. You can't value a company by just projecting 10 years of cash flows and just letting it loose, saying, no, nothing after year 10. So we estimate a number that we try to at least claim captures the cash flows that happen beyond that point in time. You know what I mean by that? You stop in year 5 and you come up with a number and say, this is what I think the cash flows beyond year 5 are worth. It's called a terminal value. There are terrible ways of estimating it. We'll talk about those, and consistent ways of estimating it. And we'll talk about rules you have to impose to make sure it doesn't run away from you, because it is the number that if you're not careful can blow up your valuation. And of course, you've got to pick the model that's right for you as a company. So with that structure, let's lay out the inputs. So first, make a decision. Are you valuing equity or are you valuing the firm? Because every single parameter you're going to estimate is going to be driven by that choice. You're going to forecast out cash flows, which will be either pre-debt, if debt to the firm, or after debt. You're going to come up with a growth rate. If you're looking at cash flows to the firm, that growth rate will be growth in operating income, earnings before interest expenses. But you're talking about equity income, it will be net income, earnings per share. Notice that every single definition is framed by Are you looking at the firm or are you looking at equity? For discount rates, if you ask me what's the discount rate I should use, I'm going to ask you, how do you get cash flows? Your cash flows into equity, it's got to be cost of equity. It's to the entire business, cost of capital. And with both models, you need closure. Terminal value, which can either be of the entire company, if you're valuing the firm, or the equity of the company. So every single valuation model you're ever going to run into, a DCF model, is built around those parameters. Now, all too often, people, they look at different DCF models, model 1, model 2, and by the time they get to the 50th model, it's overwhelming, right? There's so many different ways of doing discounted cash flow valuation. There's really only one way of doing DCF, different slices, or different ways of approaching that same DCF. So to show you how much these models share in common, I'm going to take broadly the 3 different kinds of discounted cash flow models you can run into in practice and talk about what we do with each one and how they draw from the same source. So you guys are going to do a dividend discount model. You guys are going to value the firm. And for you, I'm going to give you a different test. When you use the dividend discount model, you know what you're implicitly assuming, right? That companies pay out what they can afford to pay out. Because when you use dividends, you're saying that's what they can pay out. Ask you a follow-up question. Do companies pay out what they can afford to pay out? There's actually conclusive proof that they don't. When I look at Apple, let's say I ask Apple CFO, have you paid out what you can afford to pay out? And he says, yes. I can call him a liar right there, right? What gives him away? What is it that I've done?
How do you define what you can afford to pay out? Is it like coverage or like?
None of that. I am not using any of the ratios. There is cash flow that you have left over after meeting every conceivable need. That should be potential dividend, right? So when you don't pay out what you can afford to,
It's gonna undervalue.
but there's a clue that you get in the balance sheet, right? What should happen on your balance sheet when you as a company consistently keep paying out less than you can afford to? So, since both are cash flow concepts, if you have 100 million you can afford to pay out because that's what's cash left over, you pay only 40 million. What happens to the remaining 60 million? It shows up as a larger cash balance. Retained earnings, wrong side of the balance sheet. Don't go there. Go to the asset side. Money that could be paid out that doesn't get paid out. How do you think companies end up with $200 billion cash balances like Apple? It's not manna from heaven. It's a direct result. It's not that Apple's not trying. Apple's actually returned more cash than any other company in history. It's returned almost $500 billion in cash over the last 6 or 7 years. But you know what Apple's problem is, if we can call it a problem? They're a cash machine. They keep funneling out cash and more cash keeps coming in. Companies love to have this problem. But companies don't always pay out what they can afford. So a company like Apple and Google definitely withhold cash. Because I'm not saying it's a good thing or a bad thing, but it does mean that if I use a dividend discount model to value Apple or Google, you know what I'm going to find, right? The stocks will look massively overvalued because I'm missing the cash buildup in the company. Are there companies that pay out more than they can afford? Absolutely. MLPs, banks, sometimes because they feel that investors expect them to pay even in bad years. And there, if I use a dividend discount model, guess what I'm going to find? Every bank is going to look cheap to me because I'm focusing on actual dividends and not recognizing they can't afford to pay this out. So one of the things I'm going to talk about is estimating that potential dividend. It's not rocket science. You give me a statement of cash flows as a company, not your income statement, not your balance sheet, but your statement of cash flows. I should be able to tell you how much you could afford to have paid out that year as dividend. So you got dividend discount, free cash flow to equity, free cash flow to the firm. So here's how the 3 models are the same and how they diverge. When you look at the cash flow, you focus just on dividends. Your job is the easiest, right? Look at the dividends paid. But you say, look, that might not be what they could have paid out. You come up with potential dividend, free cash flow to equity, and you will estimate cash flows before debt payments, payments that you can make to both equity investors and lenders. When you talk about growth, because you guys are equity focused, you're going to focus on growth in dividends. That's all you care about. You can focus on growth on free cash flow to equity, potential dividends, but the growth they should be talking about is growth in free cash flow to the firm, growth in operating income and pre-debt cash flows. Discount rates, because you're both focused on equity, your discount rate is a cost of equity. Now, one of the things we'll debate is, should I be using perhaps a different cost of equity for a dividend discount model? I don't think so, but I'll give you the logic that some people use. But your equity cash flows, your discount rate should be a cost of equity. But since you're focused on valuing the entire business, your discount rate should be a cost of capital. And finally, in steady state, when you get to that closure, you're estimating the present value of dividends beyond year 5 or 10. You're estimating present value of free cash flows to equity beyond year 5 or 10. And you're estimating present value of free cash flows to the firm beyond year 5 or 10. Notice how much they share in common. The only difference is how we're approaching estimating the numbers. So let's start easy. You sit down to value a company with a dividend discount model, you project out the expected dividends. Now, if you're doing a dividend discount model, you don't want to be completely lazy of just taking last year's dividend and applying the growth rate. It does make sense to start with net income and estimate a payout ratio that could change over time. It's kind of a more flexible version of a dividend discount. It's why you can use a dividend discount model to value a company that doesn't pay dividends today. Because as it goes through time, the growth rate decreases. You might see the payout ratio will change, but you're projecting out expected dividends. You discount those expected dividends at a cost of equity. You come up with the value of equity. And here's one of the challenges, at least in the US. Increasingly over the last 3 to 4 decades, what have US companies done? They've shifted away from dividends to buybacks. And you might have to wrestle with whether your dividend should be just dividends or whether you need to be including some version of buybacks to it. Still within the dividend discount model, you're just defining dividends more broadly. So dividend discount model is built around projecting dividends, discounting at a cost of equity, getting a present value of the dividends. If I come to the free cash flow to equity model, don't worry about the details of doing it. I'll give you the intuition, but we'll come back and delve into the details. You don't trust companies to pay out what they can afford to in dividends. So you come up with your own estimates of potential dividends. And I'll give you my definition. It's whatever cash flow is left over after you met every need, capital expenditures, working capital, debt payments. So that's why I said the statement of cash flows is going to kind of give it away, right? Because you tell me what you've invested in. So free cash flow to equity is potential dividend. So here, all I've done is taken the expected dividends and replace them with potential dividends. And for a company like Google and Apple, that replacement is going to make a huge difference. Apple, I think, paid like $18 billion in dividends last year. That's a lot of money. They had $90 billion in free cash flows to equity last year. Replacing 18 with 90 and building off that can give you a very different number. But again, you're doing the same thing, it's replacing actual dividends with potential dividends. And finally, if you think about valuing the entire firm, you're looking at cash flows still, but now you're looking at pre-debt cash flows. You're looking at the growth in those cash flows and discount them at the cost of capital. And now there's some cleaning up to do. Here's why. When you take cash flows to the firm, which come from operations, you discount them at the cost of capital. Even if you do everything right, what you valued are the operating assets of the company. So when I tried this on Apple, you know what I haven't valued yet? What I've left on the table. So I take cash flows of the firm at Apple, discount the cost of capital. I come up with the value of the operating assets in Apple. I haven't valued the $200 billion in cash that they have because the income from cash is not part of your operating cash flow. You know what else I haven't valued? If you have cross holdings in other companies, imagine valuing SoftBank and forgetting about the fact that they own, what, 18% of Alibaba? That's a big number to leave on the table. I'm going to spend at least a session, perhaps 2, on cleaning up what I call cleaning up the loose ends in valuation, because often when you value a firm, there are all these loose ends left that you got to bring into the valuation. So take a look at those 3 pictures because it'll show you what you're doing in common and what the differences are. Because I'm at least going to get started on the process of doing discounted cash flow valuation. So this is a very complex picture. I have this weakness of trying to fit as much as I can in one page as I can. So let me tell you very quickly what this page is setting up. It's setting up the process by which I value just about any company. Ready? I come to you with a company. You pick a company. What's the first step in the process? Start by looking at the past. For some of you, that past might go up 50 years, right? You're valuing Coca-Cola, you're valuing Kraft Heinz, you're valuing GE, it's a long past. For some of you, the past might not go that far, right? You're valuing a Peloton or a Palantir. Don't fight the facts. It is what it is. Look at the past. Don't get stuck in the past, right? A lot of people, they do valuation, take the past and act as if it's now biblical, it's religious. You got to basically stick with those numbers. There's nothing about the past that requires you to stay in the past. You're looking at the past to learn some things about your company. Like what? Is it a profitable company or an unprofitable company? Is it a fast-growing company or a slow-growing company? So by looking at the past numbers, you're saying, can I get some clues about this company? So when you look at Coca-Cola, guess what you're going to see? Huge margins. Why? Because unlike other beverage companies, Coca-Cola, the company, doesn't have any bottling plants that have been separated out. All you're doing is selling the syrup. You get huge margins. The growth, which used to be double-digit growth, is now low single digits. Why? Because it's soda. Sugary soda, health concerns are pushing back. You're learning about the company because this is now going to become the basis for the next step, which is projecting out the future. So if you're valuing Coca-Cola, you have to tell me a story. What do you think will unfold in the future? And let's face it, this is where you start to get uncomfortable, right? Why? Because I'm asking you to play God. I'm asking you to make your best judgments. And don't tell me, how do I know I'm right? You don't, nobody does. You're making your best judgments. And I'm not going to constrain you on those judgments. It's your story, your company. Those judgments might be a turnaround for Coca-Cola where it goes back to double-digit growth, or it could be that the company is going to basically go into decline like a tobacco company. What's that going to drive? It's going to drive your expectations for the future. Valuation is not financial modeling. You can't just take last year's numbers and project things out. Your job is to take the numbers from the past, but then create your own story, your own valuation for the future, your own cash flows for the future. And then when you think about discount rates, don't think of the cost of capital as coming from formulas and equations. Intuitively, here's what you're trying to estimate. The cost of equity is the rate of return that equity investors demand for investing in your shares. Now, we can use a CAPM and arbitrage, but those are models. Ultimately, it's going to come from how much risk investors see in your company and what the world looks like to them. What are their choices in terms of what they can earn on other stocks? You have to value your company in the world you're in, not the world you wished you were in. This is going to show up when you think about what risk-free rate should I use? You can look at the T-bond rate. It's like 1.8%. And part of you say, that looks too low. I think I will use 4%. Don't go there. The world you're in, your opportunity costs are driven by that 1.8%. So we're going to talk about the things you have to take as given in valuation and the dimensions on which you have choices you can make when you value companies. But the end game here is you're looking for that value, but it's going to come from a lot of judgments you make about cash flows, about risk. But that's okay, because everybody valuing this company will have to make those same judgments. So I'm going to set up the sequence of how we're going to approach this. We're going to start by looking at discount rates. Why? It is the most comfortable place to start. There are lots of stuff we can look at. So we feel at least the comfort of feeling like we're in control. It's completely illusion, but we'll act like it. So we're going to start with discount rates. Then we're going to look at the past, not again, because I've never believed in doing 100 different financial ratios. A lot of people look at the past, they compute every conceivable ratio. We're going to look at the past simply to get clues about what's happening in this company so it can help us make estimates for the future. Third step, we're going to take that daring step of saying, let's make our best judgments for the future, growth and cash flows. Fourth step, we are going to come up with that way of putting closure, the terminal value. I'm going to talk about things you should do and things you shouldn't do in the estimate terminal value. And finally, as I said, when you value the business, there are all these loose ends. What do I do with cash? What do I do with cross holdings? That's the end game. So I know we're getting towards the end, but I'm going to start on the discount rate part of the process because there's a lot of misunderstanding about discount rates and what they're supposed to do. I've already talked about the consistency rule, right? Equity cash flows, you use an equity discount rate. Cash flows are firm, you use the cost of capital. I'm going to extend that consistency rule. One of the things you will face when you value companies sometimes you have to pick a currency to value the company. In fact, let me take that back. Currency is always a choice. You can value any company in any currency. The consistency rule when it comes to currencies is if you estimate your cash flows in US dollars, the cost of capital, cost of equity have to be in US dollars. You're saying, what if it's a Turkish company? It doesn't matter. Once you've made a currency choice, your discount rate has to be in the same currency. In some parts of the world, people don't like to do things in nominal terms. I'll be more specific. Usually in Latin America for a long time, people avoided doing things in nominal terms. You know why? Inflation became so big and so unpredictable, they didn't want to deal with it. So they would do valuations in real terms. We'll talk about what can go wrong or right with this. But if your cash flows are real cash flows, your discount rate has to be real. Consistency is not just an equity versus firm. It's on currency and real versus nominal. So the discount rate in a DCF carries the burden of everything you worry about in the context of risk. Now, before we actually look at models, I'm going to set this up very simply. If you ask me to estimate a risk-adjusted cost of equity for a company, I'm going to argue that I need only 3 ingredients. First, I need a risk-free rate. You cannot do discounted cash flow valuation without a risk-free rate. I need that as a base. And of course, that will be different in different currencies. Second, I need to know what the price of risk is in the equity market. What are equity investors collectively demanding for investing in equities as well? It's called an equity risk premium. And third, I need a sense of, is this company a value more risky or less risky than the average company, a relative measure of risk. If you've taken a finance class, what is it that we use to measure this relative risk? It's a number that we throw around, the Greek alphabet.
Beta?
Beta. You know why I'm avoiding the use of the word beta? Because once I say that it comes with all this luggage, right? Modern portfolio theory, I'm just saying I need a relative measure of risk. I'll give you, in fact, a dozen different ways of measuring relative risk that don't require beta, but I do need a measure of relative risk. So ultimately, that's what our challenge is going to be, is to come up with that relative risk measure. So I'll set the table for what we're going to do next. On Wednesday, I'm going to take the uncertainty you face in valuation and break it down into buckets. It'll make uncertainty much more manageable to you. And then we're going to talk about what portion of that uncertainty should show up in your discount rate, because not everything that you worry about is meant to go into the discount rate. So let's end with that. I'll see you on Wednesday.
Yeah, set up for like 8 minutes.